What is going on, guys? Nick here, back with another video. It finally happened. After months and months of internet chatter, finally AMC took off with a huge short squeeze. It went all the way from just $2 in March last year to $20 during GameStop madness before it settled back down to the $10 mark, and then about a week ago it started to move, making it to $19 Wednesday the 26th, and then continuing up a steady march to $30 by the market close on Tuesday, June 1st. Then yesterday morning, June 2nd, AMC exploded, doubling all the way up to $60 to $70 by the time the market closed. But if you're like me, you're a loser who missed out and might be having some major FOMO. Now, I would love to make some money on AMC, but I don't really want to buy shares. With that, I totally understand that AMC could keep running up and I might miss out on a huge opportunity to make a ton of money. But like most people, I'm not super lucky at timing the market. I'm not horrible at it, but with all that's going on with all of the volume, it can be much trickier to find the perfect entry and exit point. So for those who still want to make money off of AMC, like myself, but don't want to spend their day stressed out checking Robinhood, I actually have a much easier strategy. I want to say it's foolproof, but that's only true if it ends up making money, so we'll have to wait and see for sure. I do think that it's much easier than trying to buy AMC shares and then trying to decide when the perfect time to sell them is. Okay, so it's pretty simple what we're going to do. We're going to use options to make money off of this, specifically put options. Just for anybody who doesn't know what a put option contract is, it's a contract to sell somebody 100 shares at a set price by a set date. I think sometimes this is really hard to explain with stocks because the numbers get really confusing, so I'm going to use a house as an example. So let's pretend that you own a pretty sweet house worth $1 million right now, but you're worried the housing market might come down in the near future. What you'd be doing is buying a contract for, let's say, $25,000 for the guarantee to sell somebody your house for $800,000. This doesn't mean that you have to sell it at $800,000, it just means you have the option to do it. This means that if the housing market does fall and your house is only worth $600,000, somebody else is still on the hook to buy your house for $800,000. Right now, I can buy a $67 put that expires this Friday, which just means the right to sell somebody 100 shares of AMC for $67 by Friday for $14.48 per share. And since you have to buy a bundle of 100 shares for each option, this means for the right to sell somebody 100 shares of AMC on this Friday at $67 per share, it's going to cost me $1,448. This is a massive price for a put where the strike price and the share price are roughly equal. For example, if we look at Apple puts that also expire this Friday, it currently costs only 37 cents per share, or $37, for the right to sell somebody 100 shares at $124 per share. The reason the price is so expensive right now for these puts is because there's a lot of uncertainty over which way the stock is going to go, and we can use this to our advantage. If we pull up GameStop's chart, we can see how right after the first squeeze, the stock ended up falling a pretty good amount. The main squeeze was for about 4 days. It went from $30 to $40 the week before, and then we saw the moonshot hitting a high of $450 before it gapped back down to $50, eventually hitting a low of $40. A second, smaller squeeze took place about a month later, taking it back up to $250 to $300. So if you're like me and you want to get in on the action, but you really don't want to take the risk of buying all the shares at all-time highs, especially when the chart pattern is what I'm going to call a brick wall. You can see a very clear floor followed up with the brick wall here. So earlier I talked about puts, where you buy a contract to make somebody buy shares from you at a set price. But the problem is these puts are currently very expensive and the stock has to fall very far for you to end up breaking even. Even if you can sell somebody 100 shares at $67 per share this Friday, it's going to cost you almost $15 per share, which means the stock price would have to fall below $52 for you to even make money. I'm not sure that that's really all that likely with all the attention on AMC right now. If we look back at GameStop, even though it did fall back down pretty dramatically after the initial squeeze, it never fell below the pre-squeeze run-up price of about $40. This was basically a support line for the stock. So the way that we can use this to our advantage is if we sell somebody a put right around this pre-run-up price. What that means is somebody will be able to make us buy 100 shares of AMC at the price that we picked, or the strike price, and then for that contract, we get a very juicy premium. So what I did was I sold somebody a put contract at $23 that doesn't expire until August 20th for $6.70 per share. That means as long as AMC stays above $23 per share by August 20th, the person won't have any reason to sell me these shares because they'd be able to sell them on the open market for more money. And I get to walk away with my $670 that I was paid. However, most brokerages won't let you do this unless you have enough cash to buy the shares. So for each contract I sell, I would need 23 times 100, so 2,300 minus the $670 I was just paid. So about $1,630 as collateral. This would also be my max loss if the stock somehow fell to $0. So now what we can do to decrease some of this risk and put the risk reward a little more in our favor is to buy a put just below the put we sold. This is called a put credit spread. Now don't worry, I'm going to summarize all of this at the end so it's easier to follow. So we're going to buy a put at the $19 strike price that expires on the same day as the put that we just sold. So buying this put means that I'm giving up some of that $670 premium that I just got. In this case, I have to give back $447 per contract. This brings our max gain down to $223. But this also means that our max loss is much less, since now we get to sell somebody 100 shares for $19 each. Our max loss is now at a total of $400, which is just 23 minus 19 times 100. But also remember that we got paid $223, so our max loss is really $177. But now instead of hitting our max loss at $0, we'll hit it at 19. So for a potential max gain of $223, we're now only risking $177 per contract that we purchase. Again, the strategy is called a put credit spread. The way it's normally used is you're just betting the stock will either go up or stay the same. In this case, we're betting that it's either going to go up or at least not fall by 64% by August 20th. And this is all because of what I talked about earlier about those juicy premiums. We're taking advantage of the extra premium with all the volatility surrounding the stock to get a bigger reward and potentially doubling our money without even having to stress about day trading AMC and dealing with trading halts and Robinhood glitches. Now, you don't have to do it the exact same way that I did it. In fact, some of the premium has come down since I bought the option, so it's now about a 50-50 risk to reward. When the market opens on June 3rd, you'll have to see what's actually available. So to make all of this really simple, this is what you really need to know. You need to sell a put and then buy a put at a lower strike price. You're risking the distance between these two puts times 100 minus what you got paid for this contract. So in my case, 23 minus 19 equals 400, and then you subtract the $223 credit, ending up with $177. As long as the stock stays above $23, you're going to make money here. If the volatility does come down for AMC, most likely the amount per contract will also. This should give you the opportunity to sell your credit spread back early when you've already made the majority of your money. Now, you do not have to use the exact options that I bought and sold, so don't only think about the August 23 and $19 strikes. Look around at different dates and different contract strike prices. These prices will have changed by the time that you're seeing this, but as long as you understand the general concept of selling somebody a put below the pre-run-up price for AMC, I think you're going to do very well. Last, do not gamble your life savings on this. I am not a fortune teller. I cannot predict the future exactly, so none of this is obviously guaranteed. Only risk what you're willing to potentially lose. However, I do feel extremely confident in this trade, and I expect to do much better than this than I would if I tried day trading AMC. If you know somebody who ends up doing better than doubling their money on this stock, then congratulations to them, but I would bet that the overwhelming majority won't make 100% return without either some serious luck or skill. So that's the video, and as always, thanks for watching.